Hey, what's up, everybody? Welcome back to Investing Sucks. And today I want to talk about SoFi. And the reason I want to talk about SoFi is because, to be brutally honest with you, this company has been getting a lot of attention from retail investors lately. And almost all of the discussion I see about this company tends to be talking about the positives, talking about the bull cases, and why you should be invested in this company. So today I actually want to play devil's advocate and present a bear thesis to everyone. Now, I also want to say that what I'm showing you in this video isn't necessarily my personal opinion on SoFi stock. My goal here is to showcase a bear case just to kind of balance out the argument, right? I'm not long or I'm not short SoFi, so I have no actual true opinion on the company, but based on my research, this is what I think the bear case in it would probably be. So there seems to be quite a lot of confusion about this stock right now and why it's done so poorly in the year 2024 when the rest of the S&P 500 has done pretty well. The S&P 500 is up about 12-13% on the year, whereas we can see here SoFi is down about 35% on the year, which is honestly pretty terrible. Now, I don't mean to sound condescending or dismissive when I say this, but a lot of the commentary that I see about SoFi, I mean, this stock literally has its own subreddit with, daily chats, people talking about it every day. A lot of the commentary seems to be either missing key points or just being too optimistic, in my opinion. And optimism is a good thing, but you also have to be grounded in reality. Now, SoFi as a company is undoubtedly very, very interesting, right? They're kind of this outlier disruptor type in the banking industry, and investing in them, you feel you're a part of this new wave of doing banking, right? It represents the future of what banking is going to look like for everyone. So by investing in SoFi, you're investing in the future essentially, which it's a very enticing mission that they're on, right? They're trying to revolutionize an industry, which is fine. I'm not saying that's necessarily a bad thing, but I think to be successful in investing, you have to be extremely, extremely objective. And the fact of the matter is, with a company like SoFi, it's significantly harder to be objective just because it's such an enticing mission that they're on. Okay, so let's start with something easy, which is why is it that SoFi stock is falling so much in the year 2024? Now, I think this is primarily due to two main things. So, one is that it's become apparent to investors that SoFi is a bank, they're not a technology company. And as a result of that, a bank's ability to grow their revenue and grow their earnings well into the future is inherently limited by things like regulatory requirements, like capital adequacy ratios, which they have to abide by, but also, more importantly, the availability of credit-worthy borrowers for the specific types of loans that they offer, which for SoFi does seem to be shrinking due to things like potentially higher for longer interest rates, relatively high inflation that you're seeing in the US economy, and those kinds of things. And then number two, the one aspect of their business that does not operate like a bank, which is their technology segment, has started to stagnate a little bit, and management hasn't really given that many details on it. So one thing I want to point out is in a recent earnings call, so this is Q4 2023, they did give some pretty strong guidance here. So they're saying they're looking to achieve across the entire bank EPS between 0.55 and zero point 0.8 per share by the year 2026. So basically 2 fiscal years from now, right? Which if we take their current stock price of roughly $6.50 per share, compare that to the midpoint of that guidance, we can call it roughly a 10x forward, 2-year forward PE ratio, which for a bank like SoFi that is not very diversified in terms of the types of loans they offer and also the regions that they operate in. I mean, they really only offer a few different types of loans, personal loans, student loans, credit cards, those kinds of things. And they do have other business lines right now, like their technology segment, and then also all the other services they offer in the financial services segment. But where they're going to make the vast majority of their money is on interest income on those loans, right? That's what's going to make them the most money going forward. So a 10x 2-year forward PE ratio for a company like that is honestly kind of high in my opinion, right? And to put this into a bit of context, one company that I have talked about extensively on this channel in the past is EQB. So EQB, it's a Canadian bank stock. It's a company that I own that is actually pretty similar to SoFi in a lot of ways in that they're growing very fast. We can see their 5-year compound revenue growth rate is about 25%. They are very, very tech focused as well. EQB is a entirely digital bank that has received very high ratings for their customer experience as well, similar to SoFi. And they both specialize in just a few different types of loans. So in the case of EQB, it's mortgages in Canada. With SoFi, it's personal student loans in the United States. So EQB trades at a PE multiple of 7.5 times, as we can see here. That's 7.5 times last year's earnings, right? Whereas with SoFi, we're talking about potentially 10 times earnings that they're going to achieve 2 years from now, right? So that's a very big difference. And what I also think is pretty easy to do, especially among retail investors, is when you kind of look at SoFi's stock price and you go back to, say, this time in 2021 where it was significantly higher, it was in the range here, $20 to $25 per share. You can see that and just think, well, what if they can just get back to that level, right? But one thing you got to understand is this level's gone, okay? And this level is gone. It's probably not coming back for at least several years. This was 2021, right? This was zero interest rates, just peak crackhead valuation, NFTs, speculation mania. So this level's gone, right? This is gone. It's not coming back for a while. So now what's in reality is what we're seeing here. So SoFi is being valued by investors for what it actually is, which is a fast growing, objectively, it's a very fast growing bank stock that does have a lot of risk associated with it because they're hyper exposed to one type of borrower, right? Which is the US consumer with high FICO scores, right? To be fair to them. And by the way, SoFi also does spend a crap ton on sales and marketing because they're trying to drive that member growth as well. So I guess you could say that what the core of my bear thesis is in SoFi is probably just a disagreement on what the appropriate multiple is to value this company at. I personally think 10x based off of earnings that they're going to have 2 years from now is a little aggressive, but some people may see that as pretty cheap just because they're more optimistic about the company overall. And that's probably where most of the disagreement is going to come from. But one thing I want to point out to kind of strengthen my argument in this case is something that I put together, this script that I put together on my website, which by the way, this website is called tickernomics.com. It's a website that I created that is currently free to use. So if you are interested in, using the website, taking a look at some of the functionality that we have, link will be in the description of this video. So feel free to do that if you are interested. But basically this script I created, what this does is it generates a list of US regional bank stocks that have market caps that are kind of between $1 billion and $20 billion. And it generates a list of those, and it also shows what their historical revenue growth rate has been and what PE multiple investors are valuing them based off of that revenue growth rate, because that is one of the many factors that goes into determining what the appropriate multiple is for a bank stock, right? Historical growth. Faster growing banks will have higher multiples, but there's plenty of other factors that go into it as well, right? One of which is diversification, which I've already kind of talked about. So I'll sort this category here. So this is their 3 year average revenue growth rate. And here's plenty of companies, plenty of banks that are growing at very fast rates, right? Now, if we go back to this, we can see that what SoFi management has guided for over the next few years, 2023 to 2026, they see 20 to 25% compound annual revenue growth, right? Well, here's a whole list of banks that actually grew faster than that, right? 38% growth, 33, 28, 26, 26, 25%. What kind of PE multiples are these banks valued at? Generally high single digit multiples, right? Here's an 8, 8.3, 7.2, 5.6, 12, 8.8. Here's a few that are a bit higher. But you get the idea, right? This is just generally what banking multiples look like for fast growing bank stocks. Now, there's probably some SoFi bulls that are watching this video that are looking at this and they just spat out their coffee in disgust, thinking, how can you compare a company as revolutionary as SoFi to all these old person, these boomer, boring, bank stocks, right? They're not the same. They're not comparable. SoFi has a lot much better technology, and you have to assign some value to that technology, which is true. I do believe that. But it has to flow through to the numbers at the end of the day. And the fact of the matter is, this is what management is saying revenue growth is going to look like going forward, right? 20 to 25%, which for a bank is, that's pretty solid revenue growth, right? And that's kind of what you need for a company like SoFi that is still valued a little bit aggressively, right? There's a lot of growth priced into their valuation right now. So that's what that technology looks like, at least the way I see it, right? And really, the point that I'm trying to make here by showing you this is SoFi is always going to trade at what looks like a very cheap, a very low valuation multiple because they're just not as diversified as a bigger bank is, like say JP Morgan or Bank of America, right? And diversification in banking is a big, big thing because what you do is you spread out the risks in the economy that you're exposed to across, a whole wide range of different loan products and different loan portfolios that you have. For example, If, commercial real estate, let's say, starts to lose a lot of value, which it is, right? For a company like JP Morgan, that's obviously not ideal for them, but it's not necessarily going to ruin them, right? Whereas if you have a bank that just focuses on one specific area, like, I don't know, maybe Silicon Valley Bank, for example, if something happens in that one area that they specialize in, that can definitely ruin them, right? Especially if you're a smaller bank that's not really in that too big to fail category yet. So investors know that, right? And you have to assign some level of risk to that because it's something that could happen, right? It's something that could happen 5 years from now, 10 years from now. And if you're just not diversified, then there's always that risk that is present. And what that looks like is probably, high single digit PE multiples. Okay, so now I want to talk about something else that was brought up in a recent earnings call by SoFi management, which is macroeconomic conditions, right? And how they're dealing with the current macroeconomic conditions. And this also kind of highlights the point that I just made about the risk associated with investing in a bank stock that isn't very diversified, right? Because so much of the revenue comes from interest income on personal loans, student loans, credit cards, and all of that depends on the health of the American consumer. So if we start to see things in the economy, like layoffs or potentially higher for longer interest rates, then that means that their main source of revenue is going to be at risk. And what we're starting to see here is charge-offs increase significantly, right? So this kind of maps what the charge-offs have been in their personal loan portfolio and then across their entire loan portfolio going back to 2021. You can see it pretty much doubled from mid 2022, where it was called about 2% for personal loans, all the way up to over 4% in Q4 of 2023, which is a very significant increase, right? That basically means it doubled over that time frame. Now, I will say that this chart does look a lot worse than it actually is because the starting point of this is 2021. And 2021 was back in the stimulus check days, and not just SoFi, pretty much any bank stock out there was reporting charge-offs at historic lows during that time. But the fact of the matter is charge-offs are increasing and they're increasing at a alarmingly high rate for SoFi, which isn't good because that means they're taking more losses and also that future pipeline of interest income that they're going to generate from their personal loans is now gone if they have to charge off that loan, right? So if we actually take a look at what they said about the macroeconomic conditions in their Q4 2023 transcript here, they're saying, we're taking a conservative and pragmatic approach toward our lending segment revenue, expecting to largely maintain it given our concerns about the 2024 macro environment as it relates to uncertainty on rates, the economy, and industry liquidity. Therefore, we will manage lending segment revenue to be 92 to 95% of 2023. So they're basically saying they're expecting revenue in their lending segment to decline, right? Which for a company that is priced for growth like SoFi, that obviously means that's a big, change of pace, right? And that means the stock is going to come down as it did, right? So then something that they did in Q1 of 2024, so the very next quarter, to mitigate some of these losses was securitize some of their personal loans that were at a high risk of defaulting, which is why we see this slight decrease here in their charge-offs in 2024, right? So it wasn't an actual like improvement for the American consumer per se, but they basically just took some steps to mitigate those losses, which is good in the sense that it helps you avoid losses, but it also means that you miss out on that future stream of interest income, which is where they make the most money. Okay, so now it's time to numerically explain the bear thesis in SoFi using an actual valuation model that takes into account certain assumptions about the future growth in the business and ends up determining a projected return that we would get by investing in this company. Now, I'm not going to explain every single input that I have put into this model, but at a high level, what I did was project out the revenue growth rates and the contribution margins of each of the three segments that SoFi has, so the lending segment, technology segment, and then the financial services segment. And then what I did once I did that was deduct the non-directly attributable expenses that aren't captured in this contribution margin here, deduct the potential provision for credit losses, deduct the income tax expense to arrive at basically an estimate of what their earnings slash net income is going to be for each year going out into the year 2028. And then just divide that by their shares outstanding and we'll get an estimated EPS, right? So overall, these projections I think are pretty optimistic, but they're still attainable for SoFi, right? Because as we can see here, I have pretty much every segment growing very fast, right? Especially the financial services segment. I'm saying 75% revenue growth, 50% revenue growth. The technology segment growing at 20% per year. The one that's not optimistic would be the revenue growth into 2024 for the lending segment, but that's just based off of what I pointed out earlier, which is what management said in their earnings call, which is they are expecting to decrease the amount of lending revenue because they're kind of waiting for more clarity on the macro picture, right? But then it immediately resumes to growing fast in the year 2025. So really all these projections here are just based off of what management has guided for in the past. I didn't do anything crazy making this models, but it's still, I would say, pretty optimistic. And then the other key input that I want to briefly touch on is the shares outstanding, right? Because this is very important for a company like SoFi. And shares outstanding is going to keep going up because they offer RSUs, restricted stock units, to attract and retain employees, right? The top talent they need to keep by giving them these RSUs. And they did recently state that they plan on switching more towards performance stock awards as opposed to these RSUs. But as it stands today, these RSUs are still in place and they will keep vesting for the next few years, which will cause dilution for the current shareholder base. So dilution is just something you're going to have to live with SoFi, right? I don't think they plan on buying back shares anytime soon, so I would expect to see this keep trickling up as the years go on. And then once we have our estimated EPS for each year, we basically just apply a PE multiple to that for the year 2028 to project what our returns would be by the year 2028. So that's what this does here, right? We get a multiple of earnings and a low, middle, and high scenario. Apply that to the 1.09 in EPS we're projecting for 2028. Compare that to the current stock price, and then we get basically an estimated annualized return under each scenario. Now, I'm sure, again, a big point of contention is going to be the multiples that I used for this. I personally think these are more than fair, but obviously, if you use a higher multiple, if you use one like 15, then the returns are going to look a lot better. Again, it's a very undiversified bank stock. There's a lot of risk associated in it. These are probably what the multiples are going to be. But, again, that's my opinion. But as we can see here, the scenarios in terms of the returns look just all right. In our middle scenario, which again, I think this is pretty optimistic, right? These assumptions here. This basically assumes that they're firing on all cylinders in all of their segments, right? And basically nothing goes wrong until 2028, which I think is unlikely. And it's not really wise to invest based off of that assumption. But again, it could happen, right? It is within the realm of possibilities. But even if that happens, in our middle scenario, we're projecting 12.3% annualized return. Now, keep in mind, the S&P 500 historically has done about 8% to 10% per year over long periods of time. So you're only really getting a boost of 2.5% by investing in SoFi, which doesn't really seem worth the risk, in my opinion, right? So really, the bear thesis for SoFi would be that even if they achieve such lofty targets, the returns you're going to get in those scenarios probably aren't even that great. So again, it just goes back to the risk reward. In my opinion, it just doesn't really seem like it's there. What really seems like it's more feasible is something kind of in the range of 5, 6, 7% annualized returns, which again, considering the risk, just doesn't seem worth it. But I'm sure there's some people that disagree with that, so feel free to let me know in the comments what your thoughts are on SoFi. And also feel free to join my Discord as well if you want to connect with me directly. I'll leave a link in the description of this video for that as well. And yeah, I hope you guys found this insightful. If you did, please leave a like and subscribe if you're new to my channel. And I'll see you guys in the next video.